Welcome to the accounting class. In this session we shall take our first look at corporations. Corporations carry out most of the business in the United States, particularly in terms of volume of sales, even though there are many sole proprietors and partnerships. We shall begin by asking the question, what are corporations? Corporations are legal entities. This sets them apart from proprietorships. Since they are legal entities, this means that they must obey the laws that govern how they can be run. Of course, this might not always be done, but the costs are high if you choose to disobey the law. The government requires that corporations pay taxes on net income. So just who owns a corporation? The answer to that is that it might be many people, even thousands of individuals. Each of the individuals who has a share in the ownership is referred to as a stockholder. Stockholders are able to trade their ownership, and large corporations are quoted on the stock exchange. Stock can be regarded as a means of measuring the ownership of a corporation. That record of ownership is recorded on a certificate. If anybody can buy a share in the ownership, the stock is being traded freely. The corporation is then described as a publicly held corporation. Sometimes the stock is not traded publicly, and then the corporation is known as a privately held corporation. So what makes a corporation different from the proprietorships we have considered? It is a legal entity. It is separate from its owners. It can buy and sell assets, goods and services in its own name. It can borrow money in its own name. It has to pay taxes as a separate entity. As a legal entity, it can be sued. Okay, you have bought stock. You are an owner. What can't you do? Well, this depends. Some stockholders may also have a position within the corporation, but most will not, and this applies to them. You cannot go out and buy assets or goods for the corporation, nor can you enter into contracts for the corporation. Remember, the corporation is a separate legal entity. If you were in partnership, then you might be able to do some of these things. A corporation has limited liability. This makes it very different from a proprietorship. It means that as a stockholder, your own personal assets are not put at risk. That sounds appealing, very appealing in fact. So what if a corporation does go bankrupt? Well, the first people in the queue for any assets that are realised are the creditors. The worst that can happen to a stockholder is loss of the capital they have invested. Will I get to know the other owners if I'm a stockholder? That is rather unlikely, since the ownership can change on a daily basis. Almost anyone can buy or sell stock freely. Nobody can dictate to you what you buy or who you sell to. How does a corporation get more money? As a legal entity, it can take out a loan in the name of the corporation, or it can choose to issue more stock. What happens when somebody who owns stock dies? Their stock can be sold, or they may transfer their legal interest to another person, but the corporation can still continue as usual. So how long could a corporation go on for? Well, corporations are usually limited by the terms of the original charter. So there are some corporations that are set up for a limited amount of time. but most of them have open charters and could, in theory, continue trading forever. If I am an owner, who's running this business on my behalf and how's it going to be done? Well, as a stockholder, you elect a board of directors. The board will then elect its chairperson and any other officers. The board will then appoint salaried officers, including a chief executive officer, to see to the daily running of the company. One of those officers or managers will be a chief financial officer. The chief financial officer reports back to the chief executive officer and to the board of directors. Beneath the chief financial officer will be a treasurer and a financial controller. Beneath these will be accountants and bookkeepers. You may well be starting or hoping to start in one of these positions. How responsible are corporations in accounting terms? Well, after Enron and WorldCom, a number of regulations were changed. Although in practice, the day-to-day rules have changed very little. At the top end, it is federal law that governs the sale of stock. And these laws will also set out how a corporation is to be taxed. The financial reporting is done under the watchful eye of the Securities and Exchange Commission, although clearly they cannot look at every single report produced by every single corporation in the United States. The Sarbanes-Oxley Act defined a little more clearly where some of the responsibilities lay. Each state in the USA may have laws for issuing and withdrawing stock. Corporations will pay taxes on taxable income. When stockholders receive dividends, these are also taxed. This is often referred to as double taxation. This increased taxation is a disadvantage when compared to sole proprietors. This is the end of the first session on corporations. Thank you for watching and for listening.